$10,000 is a legitimate starting budget for real estate, but the internet confuses passive investing with buying a full-time job. The catch is currency. When your financial capital is low, you have to bridge the gap. You pay in free time, you pay in privacy, or taking on operational risk. There are 4 viable paths you can take with a $10,000 budget right now. Finding the right one requires knowing exactly what hidden costs you are willing to absorb. This chart maps how these strategies behave. The horizontal axis tracks daily effort, and the vertical axis measures initial financial yield. Down in the corner, fractional ownership requires minimal effort, but produces the lowest initial returns. Moving up the board, modifying your actual living situation takes moderate effort, but it offers massive financial leverage. And up here at the extreme end, treating real estate as a daily sales operation demands maximum effort for the highest immediate cash flow.
Success in real estate does not come from finding an objectively perfect strategy. It comes from choosing the quadrant that matches your actual life constraints. Let's look at the first path, built for the optimizer. This is someone who is busy building a career, has zero free time, and just wants their money working in the background. Look at this dashboard layout. Platforms like Fundrise or Arrived allow you to invest as little as $10 into highly diversified, large-scale property portfolios. From an operational standpoint, your input is zero. You don't need a real estate license, you don't evaluate market data, and you never deal with a tenant. This table breaks down expected output. Over the past 2 decades, average REITs returned 11 to 12% annually in predictable dividends. But the trade-off is speed. Compounding is slow, sacrificing the explosive wealth generation of controlling leveraged assets. REITs make sense when you are entirely willing to trade maximum wealth velocity for total peace of mind. The second path is for the lifestyle compromiser. This is someone flexible enough to radically alter their living situation for long-term financial leverage. With an FHA loan, you can secure a property with just 3.5% down. That means $10,000 is enough capital to control an entire multi-unit building in dozens of markets. But here is the operational reality. You have to physically move into the property. You must live on-site, occupying one of the units or a spare bedroom for at least a year. In exchange, the rent collected from the adjacent units goes directly toward your mortgage. In many cases, it drastically reduces your personal housing cost, while your tenants build your equity. This comparison table highlights the specific hidden costs. You lose your privacy. You are geographically anchored to one building, and you carry the stress of acting as a live-in property manager. But if you can tolerate those conditions, weaponizing your living situation is the most powerful wealth-building tool on this list. Finally, we have the active paths, built for the hustler. This is the person who is cash poor but has the time and drive to grind for high returns. In wholesaling, your $10,000 is not a down payment. It is entirely a direct marketing budget used to hunt down distressed properties. In short-term rental arbitrage, that same capital is immediately consumed by signing leases, furnishing apartments, and paying initial platform fees. Both strategies are severe operational drains. They demand 20 to 40 hours a week of aggressive sales work, hospitality management, and continuous market research. The output matches the effort. Arbitrage can generate $1,500 to $4,000 a month in immediate cash flow, while wholesaling can yield lump sum assignment fees of $5,000 to $20,000 per deal. But the structural vulnerabilities are massive. You are at the total mercy of local municipalities. A single city council vote can result in a sudden citywide Airbnb ban. Look at the trade-off row on this table. These are high-risk operational jobs where you hold absolutely zero physical property equity. The active paths offer the fastest financial turnaround, but they carry the absolute highest risk of personal burnout. You shouldn't select a strategy based on the highest promised return. You select it based on the operational reality your life can actually handle. This decision tree will definitively map you to your correct starting path. We begin with your $10,000 budget. The first filtering question is brutal. Do you actually have 20 or more free hours a week to dedicate to a second job? If yes, your free time subsidizes your lack of capital. You are routed to the active paths of arbitrage and wholesaling. If you lack that time, we filter for flexibility. Are you willing to uproot your life and share walls with tenants? A yes here routes the flexible, young professional straight to the high-leverage physical equity of FHA house hacking.
and a no routes the established time-poor earner directly to the strictly passive fractional ownership of REITs and crowdfunding. Before you deploy a single dollar into any of these paths, use analytical tools like DealCheck or AirDNA to audit the actual data in your local market. Self-awareness is the absolute first step of investing. Which of these 3 profiles actually fits your life right now? Let me know in the comments.